Welcome to this video tutorial where we're going to be looking at using management and accounting information. In this discussion, we're going to look at starting with why employees need information. The first three major sections in our discussion should answer the following questions. How can information reduce risk when making a decision? What is a management information system? And how do employees use a management information system? Then we'll take a look at why accounting information is so important in our organizations and attempts to improve financial reporting and careers in the accounting industry are just as important. Then we'll look at some basic accounting equations and the three most important financial statements, that being the balance sheet, the income statement, and the statement of cash flows. Lastly, we'll take a look at how managers evaluate the organization's financial health. Information is one of the four major resources, along with, of course, material, human, and financial. That these four major resources managers must have to operate a business for an organization. Information helps managers reduce risk when they're making decisions. To improve the decision-making process and reduce risk, the information used by individuals and business firms must be relevant or useful to meet some type of specific need. Better intelligence and knowledge that lead to better decisions are especially important because they can provide a competitive edge and improve an overall organization's profits. Theoretically, with accurate and complete information, there's no risk whatsoever. On the other hand, a decision made without any information is simply a gamble. For the most part, business decision makers see themselves located someplace between both of these extremes. When the amount of information available to a business decision maker is high, there is less risk. When the amount of available information is low, there is much more risk. Information, when understood properly, should produce knowledge and empowers managers and employees to make more informed decisions. An information rule emerges when research confirms the same results each time that it studies the same or a similar set of circumstances. Business people are going to try to accumulate information rules to shorten the time that they spend analyzing their available choices. Information rules, I've mentioned this term, well, these are the great simplifiers for all decision makers. Business research is continuously looking for new rules that can be put to good use and looking to discredit those old ones that are no longer valid. Now let's take a look at the difference between data and information. Many people use the terms data and information interchangeably, but the two are different in many ways, or at least very important ways. Data is just numerical or verbal descriptions that usually result from some sort of measurement. Now, information, this is that data presented in a form that's useful for some specific purpose. For any manager, information presented in a practical, useful form, such as a graph, is going to simplify their decision-making process. Just remember that data is just kind of some raw bits, but information is where we take that information or take that data and make it useful. Now let's discuss knowledge management. The average organization maintains a great deal of data that can be transformed into some useful information. A database is a single collection of data and information that's stored in one place that can be used by people throughout the organization in making decisions. Although different types of databases are important, the way the data and the information are used is even more important and valuable to your organization. As a result, management information experts now use the term knowledge management to describe an organization's procedures for generating, using, and sharing the data and information. Today, integrated software combines many functions in a single package. Integrated packages allow for the easy linking of text, numerical data, graphs, photographs, and even audiovisual clips. Integration offers at least two other benefits when we're talking about business application software. Once the data has been entered into an application in an integrated package, the data can be used in another integrated package without having to duplicate or re-enter that data. In addition, once a user learns one application, it's typically much easier to learn another application in an integrated package. Now let's introduce what a management information system is. A management information system, typically referred to as an MIS, is just a system that provides managers and employees with the information they need to perform their jobs as effectively as possible. The purpose of our management information systems, sometimes simply referred to as an information technology system or an IT system, the purpose of these is to distribute timely and useful information from both internal as well as external sources to the managers and the employees who need the information. Today, many organizations are going to be categorized into 5 areas of management: finance, operations, marketing, human resources, and administration. Management in each of these specific areas needs very clear information to be able to make informed decisions. Our financial managers must ensure that the firm's managers and employees, lenders and suppliers, stockholders and potential investors, and government agencies have the information they need to measure the overall financial health of the organization. Now, operations managers are concerned with present and future sales levels, current inventory levels of work in process, as well as those of finished goods, and the availability and cost of the resources that are used to produce the products and services of the organization. Our marketing managers need to have detailed information about an organization's products and services and those offered by its competitors in the market, including such things as pricing strategies, new promotional campaigns, and products that the competitors are test marketing. Information concerning the organization's customers, current and projected market share, and new and pending product legislation is also quite important. Human resources, well, their managers must be aware of anything that pertains to an organization's employees, such as current wage levels and benefits packages, both within the organization and in organizations that compete for our valuable employees. We also need to be worried about current legislation and court decisions that affect employment practices and the firm's plans for its growth, any possible expansion or merger that may be coming available. Administrative managers are responsible for the overall management of the organization. They're concerned with the coordination of information. Administrators must ensure that the information is used in a very consistent manner throughout your organization. Administrative managers must make sure that all managers and employees are able to use the information technology that's available to them and that they receive the skills training required to access available information. Administrative managers must also commit to the cost of updating the organization's management information system and providing any additional training whenever necessary. Typically, there's not a management information system that's just, fits every organization. So they must be tailored to the needs of the organization that it's going to serve. Well, if we have an information system, how do employees use a management information system in our organizations? To provide information, and management information system must perform 5 specific functions. It must collect, it must store that data, it must update the data, process the data into information, and then present that information to the users. Now let's move on to our discussion about accounting. Now, accounting is the process of systematically collecting data, analyzing, and reporting of our financial information. Although accounting information can be used to answer questions about what has happened in the past, it can also be used to help make informed decisions about the future of the organization. To improve the accuracy of their accounting information and their financial statements, businesses are going to rely on audits that are conducted by accountants employed by public accounting organizations. Now, an audit is just an examination of a company's financial statements and the accounting practices that produced those financial statements. The purpose is to make sure that a firm's financial statements have been prepared in accordance with the generally accepted accounting principles, or GAAPs. So just remember, GAAPs is generally accepted accounting principles. And these GAAPs have been developed to provide an accepted set of guidelines and practices for our U.S. organizations reporting financial information and their accounting profession. The Financial Accounting Standards Board, which establishes accounting standards for all U.S. companies, is working towards establishing a new set of standards that combines GAAPs with the international financial reporting standards. And this is going to create one set of accounting standards that can be used by both U.S. and multinational firms. Now, although an audit and resulting reports do not guarantee that a company has not, cooked their books, it does imply that the company has followed those GAAPs. Without those GAAPs and the various audit functions, there would be very little oversight or supervision, and the validity of an organization's financial statements and its accounting records would drop quickly. Organizations would find it difficult to obtain debt financing, acquire goods and services from suppliers, find investor financing, or prepare documents requested by various government agencies. Part of all of this goes back to the Sarbanes-Oxley Act that was enacted in 2002. I highly recommend looking into SOX, or Sarbanes-Oxley Act of 2002, and understand what led up to that and what the information from SOX has done for us. And there are international versions of SOX as well. As an example, there is a Japanese version called JSOX, Japanese Sarbanes-Oxley Act. Now let's look at different types of accounting. Accounting is usually broken down into two broad categories: managerial accounting and financial accounting. Now, managerial accounting provides managers and employees with the information needed to make decisions about a firm's financing, its investing, and its operating activities. Financial accounting generates financial statements and reports for people that are outside of an organization, such as your stockholders or financial analysts, bankers, lenders, and your suppliers. Additional special areas of accounting are going to include such things as cost accounting, which determines the cost of producing specific products or services for the organization. We have tax accounting. This is planning tax strategies and preparing your tax returns. Government accounting. This provides basic accounting services to ensure that tax revenues are collected and used to meet the goals of state, local, and federal agencies. And then lastly, we have not-for-profit accounting. This is helping not-for-profit organizations to account for all the donations and expenditures of the organization. Accounting can be an exciting and rewarding career, one that offers higher than average starting salaries. To be successful in the accounting industry, those employees must be responsible, honest, and of course ethical. They should have a strong background in financial management. They should definitely know how to use basic computer and financial software to process data into various accounting information that's going to be useful for analysis. And they should be able to communicate with people who need that accounting information that they can provide. Financial data are transformed into financial information that's useful and reported on three very important financial statements. You got your balance sheet, the income statement, and the statement of cash flows. Let's take a look at the accounting equation. This shows the relationship between an organization's assets, its liabilities, and owner's equity. Assets are those resources that a business actually owns, such as its cash, its inventory, the equipment on hand, and real estate. Liability, well, that's the organization's debts, what it actually owes to others, whether it's suppliers or lenders or other entities. Now, owner's equity is the difference between the total assets and the total liabilities. Essentially, what would be left for the owners if the organization's assets were sold off and the money was used to pay off its liabilities. The relationship between assets, liabilities, and owner's equity is shown by this accounting equation, where assets equals liabilities plus the owner's equity. This is the basis for the accounting process. Now, to use this equation, an organization's accountants or its accountant team must record that raw data that's coming in, the firm's day-to-day financial transactions that are occurring, using double entry bookkeeping system, a system in which financial transactions are going to be recorded as two separate accounting entities and to be maintained for the balance shown in the accounting equation. Now, at the end of a specific accounting period, the financial transactions are going to be summarized in the organization's financial statements, and that information is presented in a standardized format to make the statements as accessible as possible to the various people who may need to be using it. Now, an organization's financial statements are going to be prepared at least once a year and included in the organization's annual report. This is a report that's going to be distributed to stockholders and other interested parties that are going to describe the organization's operating activities and its current financial condition. Most organizations are also going to have financial statements that are going to be prepared semi-annually, quarterly, or even more commonly monthly. Now let's take a look at a balance sheet. Sometimes you might hear a balance sheet referred to as a statement of financial position. This is just a summary of the dollar amounts of an organization's assets, liabilities, and the owner's equity accounts at the end of a specific accounting period. The balance sheet must demonstrate that assets are equal to liabilities plus owner's equity, and the accounting equation is still in balance. Most people just think of a balance sheet as a statement that reports the financial condition of a business firm, but balance sheets apply to individuals as well. With an income statement, this is just a summary of an organization's revenues and expenses during a specified accounting period. This income statement is sometimes called the earnings statement or the statement of income and expenses. Although the difference between income and expenses is referred to as profit or loss for an organization, it is normally referred to as cash surplus or cash deficit if you're talking about individuals. It is also possible to use information from a personal income statement to construct a personal budget, a specific plan for spending your income. You can see I've got that summarized here on this screen. One term I definitely want you to be very familiar with is that of revenues. Now, revenues are the dollar amounts that are earned by an organization from selling its good or providing services or performing various business activities. Another term you should be familiar with is gross sales. These are the total dollar amount of all the goods and services sold during that accounting period. Now, deductions that could be made from this amount are going to be such things as sales returns, sales allowances, and sales discounts. Now, what's left over is the organization's net sales, that actual dollar amount that is received by the organization for all of its goods and services it has sold after adjustments for returns, allowances, and those discounts I mentioned. The next term I want to make sure we understand is cost of goods sold. The standard method of determining the cost of goods sold by a retailing or wholesaling organization during an accounting period is going to be summarized as this cost of goods is going to be your beginning inventory plus your net purchases minus that ending inventory that you're left with. Hopefully you'll take a look at that and realize how easy it is to remember cost of goods sold when you just think about, all right, here's what I have, here's what I purchased, and minus what I have left over. Now let's look at operating expenses. Now these are all the business costs other than the costs of the goods that are being sold. They're generally divided into two categories: your selling expenses or your general expenses. Your selling expenses are costs that are related to your organization's marketing activities, and general expenses are costs incurred in managing your overall business. Another very important term when we're referring to this is net income. Now, when revenues exceed expenses, the difference is called your net income. Now, when your expenses exceed your revenues, now this is called a net loss. And I've got an example here of how you can figure up your net income with your total revenue minus your total expenses. Well, what's left over? That's your net income. Now I've got an example here of a cash flow, or your statement of cash flow. This illustrates how the operating, investing, and financing activities of an organization affect cash during an accounting period. The statement of cash flow is going to focus on how much cash is on hand to pay your bills. Now this cash flow statement that you see, this is going to be organized around really 3 different activities: operating, investing, and your financing. Now cash flow from your operating activities, this is that first section. It's going to address your organization's primary revenue source, providing the goods and services. Typical adjustments are going to include adding the amount of depreciation of a firm's net income. Other adjustments for increases or decreases in amounts for accounts receivable, inventory, your accounts payable, and income tax payable are also going to be required to reflect really that true picture of your cash flow from your operating activities. Now cash flow from your investing activities, this is that second section, and it's concerned with cash flow from your investments. This includes purchases and sales of such things as land or new equipment or old equipment, getting rid of it, or other really long-term assets and investments. Now your cash flows from financing activities, this is that third section, and it deals with cash flow from all financing activities, and it reports changes in your debt obligation and the owner's equity accounts. Now the total of all 3 activities are added to the beginning cash balance to determine your ending cash balance. Together, the statement of cash flows, your balance sheet, and your income statement are going to illustrate the results of past business decisions and reflect the organization's ability to pay its debts and dividends, as well as finance any type of new growth that's projected. Now you can take a big deep breath, because we've gone over all the information about how we take raw data, turn it into useful information, and apply that to our financial and accounting information that's required, and the different areas that we are putting information into as an organization, so that we can see what the actual financial health of an organization is.